The United States is actively executing a massive and highly coordinated military buildup in the Middle East, deploying the USS Abraham Lincoln and the USS Gerald R. Ford carrier strike groups, alongside more than 150 cargo flights of munitions and over 50 advanced fighter jets, specifically including F-35s and F-22s, in preparation for potential multi-week kinetic action against Iran. Intelligence estimates internally assess a 90% probability of direct military action occurring shortly after a self-imposed early March diplomatic deadline. However, the most severe threat this action poses is not geopolitical, but rather a catastrophic macroeconomic shock to the United States economy. The American financial system is walking directly into a staggering $342 billion economic trap. Baseline defense estimates peg the direct military cost of a multi-week American air campaign at a minimum of $50 billion, accounting for aircraft fuel, munitions, personnel, and extended base operations. But the true devastation emerges from the global oil markets. Brent crude carries a rapidly rising war premium and is officially projected to spike to a range of $130 to $150 per barrel if hostilities successfully disrupt regional energy flows. Because the American economy consumes 20 million barrels of oil daily, a $40 price premium equates to $292 billion in annualized excess energy costs. Combining this localized oil premium with direct military outlays creates an immediate, mathematically certain baseline economic drag of $342 billion, a figure that remains entirely exclusive of secondary global market corrections and long-term reconstruction costs. The structural question we must ask is not merely whether the United States can sustain this immediate financial outlay, but whether the resulting fiscal expansion and systemic commodity disruption will permanently fracture the global dollar standard. The catastrophic effect on the broader United States economy accelerates violently when this energy shock transmits to the financial markets. Financial analysts model a 7% correction across the Standard & Poor's 500 and the Nasdaq, alongside a 3,000-point drop in the Dow Jones Industrial Average upon the initiation of military strikes. Because the total United States stock market capitalization sits at approximately $50 trillion, a 7% contraction mathematically destroys $3.5 trillion in total domestic wealth overnight. This massive macroeconomic disruption will transmit directly to American households, triggering a catastrophic effect on the domestic standard of living and effectively wiping out consumer purchasing power. An oil price spike to the $130 per barrel threshold translates instantly to consumer gasoline prices exceeding $6 per gallon and a projected doubling of residential heating costs. This energy premium does not remain isolated at the pump. It acts as a highly regressive tax on the American consumer, as the compounded cost of commercial transport and logistics is modeled to drive retail food prices up by an estimated 20%. Consequently, the baseline consumer price index is projected to surge from its current 4% level back up to a highly restrictive 6 or 7%. Furthermore, the sudden $3.5 trillion market contraction directly evaporates the wealth of the middle class, permanently damaging 401k plans, institutional pension funds, and individual retirement accounts. This sudden evaporation of capital places the Federal Reserve into an impossible, textbook stagflation dilemma. As the sudden energy shock drives inflation upward, the central bank will be forced to choose between raising interest rates to fight off the renewed inflation spike, which guarantees a severe economic recession and corporate failures, or keeping rates steady, which risks pushing inflation past 7 or 8% and destroying bond market confidence. As bond markets react to surging inflation, borrowing costs for consumer mortgages, auto loans, and credit cards will remain elevated, while collapsing corporate operating margins will lead to rising business failures and an immediate spike in domestic unemployment. As household purchasing power collapses, the catastrophic effect extends directly into United States industry, creating a severe operational vulnerability across multiple critical sectors. The domestic logistics backbone, encompassing maritime shipping, commercial trucking, and commercial aviation, will see its operating margins instantly and severely compressed by the surging cost of diesel and aviation fuel. Broad consumer discretionary industries will see revenues plummet, as households are forced to redirect their dwindling disposable income strictly toward essential fuel, food, and energy costs. Conversely, highly specific sectoral winners will emerge as capital reallocates. Safe haven assets are demonstrating extreme price sensitivity, with physical gold surging past $2,350 per ounce, and analysts modeling potential moves toward $3,500 as institutional investors flee risky equities. Domestically, a unique structural advantage emerges within agriculture and chemicals. A disruption in Middle Eastern energy flows will cause European natural gas prices to spike violently, mirroring the energy shock of 2022. Because natural gas is the primary input for nitrogen-based fertilizers, this will squeeze European fertilizer production margins and ultimately grant a massive structural advantage to United States domestic nitrogen and fertilizer producers. However, the most profound industrial shock centers on an asymmetric naval vulnerability that threatens the entire American defense industrial base. Iran possesses Fateh-1 hypersonic missiles capable of traveling at Mach 13 to 15, utilizing highly maneuverable re-entry vehicles that bypass traditional ballistic naval defenses. These missiles cost roughly $500,000 to $1 million to manufacture, yet they directly threaten United States naval aircraft carriers, such as the USS Gerald R. Ford, an asset that cost $13 billion to build and carries a crew of 5,600 sailors. This extreme 1 to 13,000 cost disparity fundamentally undermines the long-term mathematical viability of United States carrier-based power projection, forcing the military to reconsider its entire maritime industrial strategy. This vulnerability is fortified by a hidden structural reality that fundamentally challenges baseline assumptions of Western operational success. Iran's defense apparatus is now a highly integrated extension of Chinese military technology. Beijing has systematically upgraded Iran's defense networks, actively supplying Tehran with YLC-8B ultra-high-frequency band radars developed by the Nanjing Research Institute of Electronics Technology. These radar systems operate on longer wavelengths, specifically engineered to detect advanced stealth aircraft, such as the American B-2 Spirit and F-35 Lightning, shrinking the invisible window for American strike aircraft and allowing Iranian defense systems to activate earlier. Furthermore, Tehran has been shifted onto the Chinese Beidou satellite navigation system to completely bypass United States GPS spoofing and jamming vulnerabilities, while Western cyber infrastructure has been systematically replaced with closed, encrypted Chinese digital alternatives managed by the Ministry of State Security. Most critically, China serves as an unbreakable supply chain backstop for Iranian military-industrial capacity. Beijing is actively exporting restricted planetary mixers to Iran, highly specialized equipment that blends explosive materials for solid-fuel rocket motors. Operational satellite imagery from the Parchin and Khorramabad military complexes proves that this Chinese lifeline allows Iran to successfully reconstitute 50 to 60% of its destroyed missile manufacturing capacity within a mere 8 months of being struck by Western forces. Backed by a $400 billion, 25-year economic agreement, China secures a vital energy partner and degrades United States military hegemony through persistent proxy technology transfers, entirely avoiding the financial and political risks of direct kinetic combat. China has additionally insulated its own industrial base from the coming supply shocks by amassing immense strategic oil and gas reserves, while expanding secure overland energy imports from the Russian Federation. When analyzing the systemic positioning of developing nations and rising powers such as India within this macroeconomic shock, we observe a complex dynamic of geopolitical alignment and severe domestic economic constraint. As a rapidly developing economy heavily dependent on external commodity imports, India faces acute vulnerability to any sustained energy shock. The transmission of a $130 to $150 crude oil pricing environment operates as a highly regressive force on emerging domestic markets. While aggregate gross domestic product figures may eventually recover, the immediate inflationary pressure on essential fuel, logistics, and agricultural inputs disproportionately impacts lower-income demographics. This fundamental constraint limits the near-term capacity for equitable growth, proving that broad economic expansion does not inherently equal universal prosperity when structural supply chains are compromised. However, from a macro-geopolitical perspective, India's primary relevance is its status as a core, anchoring member of the BRICS economic bloc. A United States-driven energy shock and the subsequent expansion of Western deficit spending will likely accelerate India's active participation in BRICS-led de-dollarization efforts. To insulate its vast population from the volatility of a dollar-denominated energy market prone to political weaponization, India is structurally incentivized to accelerate the adoption of alternative trade settlement mechanisms, shifting trade flow reliance away from Western financial architecture. The broader global system context is anchored by the physical and financial flow of essential global commodities. The Strait of Hormuz acts as the central nervous system of global energy markets, processing roughly 20% of the total global oil supply, which equates to 20 million barrels daily, alongside a critically important volume of liquid natural gas. The systemic implications of disrupting this maritime corridor extend far beyond localized regional markets. Global debt currently sits near a staggering $136 trillion, of which $38 trillion is United States government debt. Sustained defense spending required for this multi-week kinetic action will aggressively exacerbate the existing United States fiscal deficit. Utilizing borrowed fiat currency to fund foreign military operations directly and permanently weakens systemic global trust in United States treasuries as the premier risk-free asset. In direct response to prolonged United States financial weaponization and sanctions regimes, BRICS nations are aggressively advancing a non-dollar settlement currency framework designed to bypass traditional Western banking systems. China has already amassed an estimated 25,000 tons of gold, with citizens holding an additional 28,000 tons, and is actively establishing financial infrastructure in hubs like Saudi Arabia through the Shanghai Gold Exchange. This allows nations to settle energy trade imbalances in physical gold rather than relying on the United States dollar system. Therefore, the kinetic action in the Persian Gulf must be viewed not merely as a military operation, but as a massive systemic accelerant for shifts in currency stability and sovereign debt exposure. As we model out the potential duration and depth of this conflict, we must introduce the critical second-order effects and hidden structural risks that fundamentally challenge baseline assumptions of a swift resolution. The foremost systemic risk is the severe domestic legislative paralysis that will follow the economic fallout. Historical data regarding midterm elections indicates that an economic crisis of this magnitude, featuring $6 gasoline and a collapsed stock market, mathematically models out to a loss of 30 to 50 seats in the House of Representatives for the incumbent party. This shifts the domestic political landscape into total gridlock, guaranteeing 2 years of investigations, blocked appointments, and legislative paralysis, exactly when the American economy requires decisive fiscal intervention to manage the stagflation crisis. Furthermore, there is a hidden commodity contagion risk that broadens the scope of the crisis far beyond crude oil. Disrupting the Strait of Hormuz is fundamentally a liquid natural gas event. This secondary impact transmits directly through European natural gas markets, causing foundational input costs to spike and threatening global agricultural yields via severe fertilizer margin destruction. Finally, the assumption of permanent dismantlement of adversary capabilities is structurally flawed. Operational history proves that targeted nations, supported by Chinese and Russian supply chains, can successfully reconstitute critical infrastructure within months. A prolonged air campaign faces severe reversal scenarios where manufacturing capacity is rebuilt faster than the political will required to repeatedly fund its destruction. Looking forward over a 3 to 10-year horizon, the long-term positioning consequences of this conflict signify a permanent and structural shift in the global macroeconomic framework. A kinetic strike on Iran should not be analyzed strictly as a localized regional security operation, but rather as a definitive catalyst for the collapse of systemic financial unipolarity. Mainstream consensus heavily models the crude oil shock, but completely ignores how the resulting United States fiscal expansion will permanently alter sovereign reserve management across the globe. The structural winners in this coming decade are nations and asset classes heavily insulated from the fiat debt system. By forcing physical energy markets offline through military action, the United States will unintentionally accelerate the transition of BRICS nations toward a new settlement currency, widely referred to as the unit, which is projected to be backed up to 40 or 50% by physical gold. This environment will trigger a massive capital rotation into hard assets, driving sustained, multi-year bull markets in monetary metals like gold and silver, as well as critical industrial metals like copper. The undeniable structural losers are Western middle-class consumers and the institutional credibility of the United States Treasury market. As adversaries utilize low-cost hypersonic technologies and deep integration with Chinese manufacturing to absorb, survive, and reconstitute from Western strikes, the United States will find its military-industrial complex financially strained and its financial hegemony heavily fractured. Over the next decade, American positioning within the global balance will be forced to retreat from operating as a unipolar economic enforcer to navigating a highly fragmented, multipolar economic reality, where the United States dollar index is projected by macro analysts to face significant long-term devaluation. To navigate these complex structural shifts, institutional investors and economic professionals require rigorous, data-driven analysis entirely free from emotional narrative and political bias. This intelligence brief outlines the fundamental realities of supply chain reorganization, capital flow disruption, and shifting global power dynamics. At Economic Times Now, we map the macroeconomic transmission paths and structural second-order effects that others routinely overlook, prioritizing rigorous consequence modeling over mainstream storytelling. If you value structured, analytical, and objective intelligence on global economic developments, we invite you to subscribe to Economic Times Now. Stay informed, stay objective, and continue to rely on ETN for your institutional macro perspective.